Hello everyone and welcome back to the deep dive. This is my Q3 2024 Tesla earnings report digest, and my main takeaway, having analyzed the report deeply, is that Tesla's cash flow production is set to soar from here over the coming year or year and a half or two, and that the stock will track along. So let's get deep into it. Tesla's average selling prices have been declining this year per the CFO's remarks during the Q3 earnings call. Despite the ASP reductions, free cash flow divided by operating margin is up 2.25x year over year, indicating that Tesla's overall efficiency has increased notably since last year. While Tesla's metrics fluctuate quarterly, its ability to print more free cash flow per share over the long term, which is ultimately what drives the stock price up, is determined by its overall efficiency levels and thus at what rate it continues to compound its manufacturing, energy and AI capabilities. I use this metric every single quarter to understand whether actually Tesla's fundamentals are improving or not, despite the more superficial KPIs. Essentially, per the aforementioned increase in efficiency, I therefore believe that Tesla's cash flow production is set to explode over the coming year or two, again with the stock broadly following suit. So let me explain this a bit deeper for everyone. Free cash flow divided by operating margin expresses how much free cash flow Tesla produces per unit of operating margin. I know this may sound a little bit strange at first, but the ideal scenario for shareholders over the long term is for this metric to trend up with operating margins actually going down. Yes, lower margins are actually a good thing. A lower operating margin makes it harder for competitors to replicate the operation profitably, while higher levels of free cash flow per unit of operating margin makes the shares more valuable because that ultimately drives up free cash flow levels per share. So what you want as a long-term investor is more free cash flow per share and lower margins to make it harder for competitors to replicate the operation. Jeff Bezos once beautifully summarized this by saying that investors can't spend margin percentages, but they can spend free cash flow. Incidentally, lower margins over time with an increased ability to produce cash is the hallmark of companies that share economies of scale with customers, which is arguably capitalism's most powerful feature. Tesla is definitely one of these companies, and another prime example is Costco, which I wrote a deep dive on recently, and you can refer to it to learn about the concept of sharing economies of scale in more depth. Now, going back to Tesla, in the graph below you can see Tesla's cash from operations hitting a low in Q1 2024 and then inflecting upwards since. The decline in cash from operations started in Q3 2022 after the Fed started raising rates in order to bring inflation under control. The graph below thus summarizes Tesla's journey to adapt its operations to a higher price of money via the attainment of higher levels of efficiency, starting to emerge victorious since Q1 2024, as you can see in the graph, with cash from operations starting to inflect upwards since. The trend has continued into Q3, with Tesla printing $6.25 billion in cash from operations, an all-time quarterly high. If the Fed now decreases rates, each efficiency increment Tesla yields from here will have a non-linear impact in its ability to print cash. However, the real source of alpha lies deep in the fundamentals. Going forward, Tesla does not need interest rate decreases in order to non-linearly enhance its ability to produce cash. Rather, the decline of interest rates is an additional element of asymmetry in the thesis and something that nor Tesla nor its shareholders can control. If the Fed decides to decrease rates, that's great because it makes cars more affordable in general, but if it doesn't, Tesla is still on the right track. Free cash flow divided by operating margin is the highest it has been for Tesla since the Q4 2020 peak, which sent the stock up tenfold in a matter of months, tracking Tesla's resultingly improved ability to print cash. And by the way, something that I think is not obvious for people is that this metric is cyclical, in that when Tesla attains a new level of efficiency, it then proceeds to decrease prices for end customers. This is how it actually shares economies of scale. And so if you refer back to that graph, you will see that the metric goes up and down, and at the moment we are in an up cycle. But what's truly interesting is the following, and is that the high point in Q4 2020 was brought about by Tesla's effort to improve its manufacturing capabilities, but that was done with a much lower price of money because the rates were much lower. And so the increment in efficiency that we begin to see in the Q3 to Q4 2020 period has actually been yielded by Tesla with an exponentially higher price of money versus the increment yielded in late 2020. What this means is that Tesla's latest efficiency cycle is actually much bigger in terms of its overall result than the one in 2020, and that therefore we can expect a proportional jump in its ability to print cash at some point in the next year or two, assuming no catastrophic events outside of Tesla's control take place. In turn, I believe that this trend will be amplified by Tesla's newly emerging business lines. Tesla is now not only a car company, but also an AI and energy company. The current efficiency gains will therefore likely manifest in the form of increased scale and margins in these two businesses over the coming years at a pace which I believe the market currently does not expect, in that it is underappreciating the speed with which this operation will pick up. This, in my view, will multiply the net effect of Tesla's efficiency gains going forward too. So this process will continue acting as a catalyzer of Tesla's ability to print cash going forward over the coming decade. In the graph below, you can see on the left-hand side of the screen, top graph, how the gross profit from energy and services continues to rise non-linearly, together with below the energy storage deployments trending up despite a lower print quarter over quarter, which apparently has been driven by simply lower customer readiness. On the right-hand side, on the top, you can see cumulative miles driven with FSD continuing to trend up following the inflection point in early 2024. And below that graph on the right-hand side of the screen, you can see how AI training capacity continues to effectively grow exponentially from the levels in late 2023. So that was not very long ago. These businesses have been in development for a long time, and my sense is that now they are a year or so away from meaningfully contributing to the income statement. Indeed, I believe the aforementioned efficiency increment is the main driver of the energy business. Progress is perhaps least visible from a financial accounting point of view on the AI side, but Tesla's autopilot and AI lead Ashok Eluswamy, I hope I'm pronouncing that well, revealed some valuable qualitative insights during the Q3 earnings call, which illustrate how FSD is perhaps just one or two versions away from redefining transportation as we know it.
Yeah, we're measuring miles between critical interventions. Like you mentioned, Elon, we already made a 100x improvement with 12.5 from starting of this year, and then with V13 release, we expect to be 1000x from the beginning, from January of this year on production release software. And this came in because of technology improvements, going to end-to-end, having higher frame rate, partly also helped by hardware force, more capabilities, so on. And we hope that we continue to scale the neural network, the data, the training compute, etc. By Q2 next year, we should cross over the average human miles per critical intervention, or like collision in that case.
My impression is that Tesla's AI is now advancing at a rate in which, in a year or two from now, the cars will be capable of surpassing human drivers across the board. In Q3, Tesla published a safety report which showed one accident per 7 million miles of autopilot. That compares to an average one crash per 700,000 miles for American drivers. In the Q3 earnings call, management also explicitly stated that they expect to launch autonomous ride-hailing in California and Texas next year, with the regulatory processes expected to be far easier in Texas, of course. Qualitatively, the FSD videos on YouTube are impressive, with the cars displaying uncanny autonomy, which is to some extent kind of scary. Meanwhile, I was surprised to learn in the Q3 earnings call that Tesla is already offering a ride-hailing capability for Tesla employees in the Bay Area, although for now the cars include a safety driver. It was especially intriguing to learn that Tesla has been working also on frictionless personalization, enabling any Tesla to look exactly like yours as soon as you get in, synchronizing seat and mirror positions, media navigation, and more. This is obviously a great value proposal for riders and clearly gives Tesla an edge in the upcoming battle against Uber. While I believe disrupting Uber will be harder for Tesla than most believe, this kind of innovation definitely gives Tesla an edge. You can learn more about how Uber is preparing to stand its ground versus Tesla in my latest Uber update. Lastly, it also caught my eye to see Tesla transitioning towards a single stack for FSD v12.5 so that both the city and highway driving come from the same piece of software. In my latest Meta update, I highlight how Meta shifted in Q2 2024 towards a unified AI model for all of its video players across its family of apps. Meta experienced an 8 to 10% increase in Reels watch time by transitioning towards a single model beforehand, and thus the aforementioned shift is expected to yield watch gains across the board. What's interesting to me is that both companies are now moving in the direction of unified AI stacks, which points to monolithic neural net architectures somehow yielding more value than disaggregated architectures. At the moment, I'm not quite sure what I will be using that piece of information for, But as is always the case, you never know when you will need that knowledge, and you never know when you will see an opportunity when others don't, because they're paying attention to small details. Towards the end of the Q&A section, it was also interesting to see Elon reference the AI at the edge problem, which I believe AMD is ideally suited to solve because it's the only semiconductor company that can provide adaptive computing at a marginal cost. Tesla's cars are trained with tremendous contextual data, and then the car has to run AI inferences with a relatively small compute engine. This problem is likely to present itself everywhere across the economy as AI makes it out into the real world. As I highlight in my recent AMD update, SpaceX's next generation satellites are powered by AMD's Versal AI chip, which essentially reconfigures itself on the go, hence the term adaptive computing, effectively changing its shape to optimize inferences at the circuit level. Indeed, Elon refers to solving the AI at the edge problem by training neural nets more so that, like a human, they don't have to think so much when it comes to acting. But as the volume of data goes up over time, the compute constraint at the edge becomes insurmountable via non-adaptive compute engines. Perhaps the amount of inference components within a given machine will go up, such as satellites, cars. They'll be making inferences for literally everything. So I think it's interesting that Elon is leaning into this problem now, and I find that AMD is really the only capable provider in the market, which is relatively evidenced by SpaceX choosing to power its latest satellites with AMD's adaptive technology, which, by the way, AMD's embedded business segment, which contains the adaptive technology, has been on a down cycle for a year or so, and the market is fairly disappointed. But I believe that the picture that this is painting is completely different. Elon is aware of the AI at the edge problem. It is a big problem to solve. SpaceX just hired AMD's chips for the satellites and so forth. So I think that this looks very bullish for AMD shareholders. Here's how Elon implicitly pointed to the AI at the edge problem during the Q3 earnings call.
You've got a case of Tesla 7 or 8 cameras that 9 if you include the internal camera that so you've got gigabytes of context and that is then distilled down into a small number of control outputs. Whereas it's like it's very rare to have. In fact, I'm not sure any LLM out there can do gigabytes of context. And then you've got to then process that in the car with a very small amount of compute power. It's all doable and it's happening, but it is a different problem than what, say, a Gemini or an OpenAI is doing. Now, part of the way you can make up for the fact that the inference computer is quite small is by spending a lot of effort on training. And just like a human, the more you train on something, the less mental workload it takes when you try to when you do it. Like when the first time a human starts driving, it absorbs your whole mind.
To conclude, I am happy to remain long on Tesla. While the energy and AI businesses are only starting to rear their heads, Tesla's overall efficiency gains are tangible, and I believe they are effectively a leading indicator of an enhanced ability to produce cash. Much like in the 2020 to 2021 period, I believe the increase in efficiency will send the stock up considerably, at this time accentuated by the emerging energy and AI businesses, because this time the efficiency is not only going to enable them to sell more cars with a better, ultimately free cash flow production ability, but it's also going to translate into a better energy and AI business than otherwise. Therefore, while I'm not sure of the quarterly timing, and I don't know how anybody could possibly be, I believe that in normal circumstances, the coming year or two will be very fun for Tesla shareholders. So thank you very much for joining me today. As always, if you enjoyed this, please share it with one friend whom you think will enjoy it. These deep dives are for free, and so the only way this grows is with your help. If you haven't, smash that subscribe button, leave me a comment, let me know what you think about this Tesla update. Specifically, I want to hear what you guys think about the AMD remarks, because the market is very disappointed with this company right now, but I remain as bullish as ever, and I'm looking forward to learning what you think about that. So thank you very much, take care, and until next time.